Trading the markets with a possible 10 to 15% rally on the cards and finding stocks with inflation resilience and cheap global growth beta with a 6% yield as a kicker. Gary Glover from Novus Capital, how are you this morning?
I'm pretty good. Pretty good.
Well, we're now in July, and you've said for some time that this would be a period to look for a bit of a mild rally. Here we are. We're kind of seeing that roll out, at least from the June lows. Those who follow your weekly reports are across the market cycles and timing. But what does 10% look like on these US indices charts you've got in this week's report?
Yeah, and I just think they're sort of bounced off some, a few sort of key fib levels. There's some important timing there, just showing a little bit of strength there. It's a bit more volume than seen the last couple of rallies there. So they're still pretty mild. So I think I'll sort of describe this to in my report there sort of just declines. So I think it'll be like a bit of a 2 steps forward, 1 sort of step back type of market. So it's going to be a bit of a grind here. So I just think it'd be a bit messy, a bit up and down here. But I do think it'll sort of try and have a bigger relief rally here. So you just never know where you're going to get here as well, whether you get sort of something a bit impulsive. So sometimes, these sort of, whether you refer to as a B wave or whatever else, but you can, they can be sort of hard working rallies, or they can be a short and sharp as well. So it feels like it's going to be a bit more of a hard working one here up into August. So so I still have the same view here. It's just definitely pretty choppy here. Obviously a bit uncertain out there at the moment. It feels like we're almost talking ourselves into a recession rather than, because all the data is still pretty positive, but there's just the market's sort of turned universally. It's like, I always say when your market's really, when everyone turns bearish, and universally bearish, that's the time to be going long. And then when obviously everyone's finally turned bullish and no one can see any reason to be selling the market after it's been running for a while, and it feels great, that's usually the time you should be selling. So it does concern me that everyone has sort of turned onto the recession bandwagon, yet the data is still pretty positive. It's not negative. And there was an interesting article there I saw on the weekend. There was just sort of like saying something similar, that we're not in a recession yet, but we might talk ourselves into one if everyone stays too negative here. So interesting perspective. But retail sales are still pretty buoyant. Unemployment numbers are still super low, so plenty of jobs, plenty of people spending money still. It's just a little bit of hesitancy around interest rates here. So some of the firms are talking about just not trying to employ too many more people, but there's still plenty of firms out there looking for people. So it's a bit of a mixed bag, really. But I guess it's I still think we'll see a little bit of a rally here up into August. That's my view at the moment.
Well, that's the NASDAQ that we had on screen there. Is that pretty much the same thing for the S&P? Sort of a bit of a grind up into August, and then
it hasn't sort of really gotten above that swing low there, but the volumes have been sort of a bit more impressive there. The daily's showing a bit more strength as well. I just think it'll probably have a bit of a rally here up into the range here. So I'm not sure what sort of size move we'll have here, but in the past we've seen some fairly decent bear market rallies. If this one seems to be, so far it's sort of playing it a bit slow, but I think we still go a bit high here.
Okay. And then you've brought out some interesting things for those students of history who quite like to look through and learn from previous markets. In this report, you've mentioned the 70s slow grind looking to be on the cards, and it's kind of in front for being the likely blueprint. But you've got a 1960s chart here of the Dow. So what can we learn from this market stage and cycle?
Yeah, so we sort of covered this last week there, sort of showed the 60s chart and then overlaid it with the current period, and just really given us some sort of good timing there. So the usual sort of midterm year and the 10 and 20 year cycle and the 60-year overlay, that's what most cycle guys will look at, all those cycles and map out a best fit. But 60 years is the one that actually, that's the one that's really probably the closest of all the cycles at the moment. That's the one that's following the the closest here so far. So yeah, just interesting. That's sort of suggesting we'll bounce up into August, retest in October. I think the 60-year cycle was actually a higher low, but I've sort of got my leaning that we'll see maybe a slight new low, but it could be a higher low. It's actually what's more important with these cycles is actually not the price, it's actually the time. So yeah, so we're looking for sort of the markets to sort of turn around those certain sort of key timings there. So far we've been bang on all the timings here. So yeah, just suggesting a little bit of a rally up into August. So we don't know what the rally is going to look like, but it's going to be strong or weak. But yeah, looking for a sort of like a mid-August sort of high here. So hopefully it can get going, give us sort of something a bit, something tangible anyway. So yeah, we'll see. You'll see. But yeah, I guess we still got to be a bit cautious out there at the moment. But I still think there's a few opportunities there for sure.
It's definitely been a good blueprint rolling out from the November highs, coming down to June, etching out a bit of a low, and then we'll see towards August. So it's good to have that blueprint to look forwards and reference back to as you're pulling out the trading shares, which is probably a good point to move to in a second. But you've got the tennis ball moment. So that's on the Australian index, the S&P 200. What is the tennis ball moment, Gary?
Yeah, so this is a bit of a, I've seen a few traders sort of talk about this even, but I know Minervini talks about it as well. Sort of, sometimes when a market sort of moves down or a stock moves down, and it kind of rejects the low and then bounces really hard. Sort of like a, obviously you got your dead cat bounce, which is markets that don't bounce, and then you've got your sort of the markets that do bounce off the lows quite aggressively, and that's sort of that's basically sort of, it's like holding a tennis ball underwater or a basketball underwater. It doesn't stay down long; it bounces straight back. So when you sort of see a market that does get sort of sold off and then bounces really hard off the lows, that's the sort of tennis ball moment I refer to, sort of almost rejection of the downside. So I like the fact that the index, it's had a pretty big drop here, 16%, as we've spoken about for the last, sort of month here. That's a big correction for the XJO. So we're only at 15%, and that 2002 bear market from the high. So it's a big drop for our market, and now we've sort of had a bit of a bounce. We've had a little, a retest, and a little bit of a tightening up a little bit, and a retest of the low again. So that little tennis ball moment there, that actually went to a new low, went slightly below that level from about a week or two earlier by 2 points. So I think that the index sort of undercut there. So it's almost like a little mini false break of the sort of higher low. You might say that's a little bit of an ABC. That's oftentimes how they sort of set up there. So not too, if you look actually at sort of February, March of 2022, the market actually bounced, then came back down, did a little bit of a little retest there, and then that's when it sort of took off there. So that sort of setup there is that's quite a common sort of setup for indices to sort of go back and retest and do a little a double sort of high low there. So yeah, so I thought it looked pretty good. I thought on Friday that rejection there and recovery was actually that's probably the one of the most bullish signs I've seen for the market so far. So that's got me reasonably confident we'll see a bit of a bounce here. But as I say, this does suggest it's going to be a bit of a messy decline. So probably just going to be a bit more measured in our approach here. Probably don't go too hard, I guess is what I'm trying to say.
Well, that's probably a good point to move to the leaders on the ASX that are putting forward the best opportunities in the market. So you've trawled through a couple of ASX companies that have good potential now and ones to keep on the short list. The first one that comes out is Treasury Wine Estate. So you've said in your report that inflation might be able to be pushed through to consumers. So looking at the macro side, that could be one aspect. What about the technical side?
Yeah, so I mean, it's funny, this one, because it's really it's literally what August last year was the high. So we're into July here, and it's really just sort of gone in a corrective sort of sideways approach there, and it really hasn't really corrected back that deep. So it's held up quite well throughout that period there, and just showing a bit of definitely showing relative strength versus the market, which is down quite heavily. So that stock is sort of, it's up near its sort of highs and that sort of in that band as well. So I think this is looking pretty robust. It looks, we're definitely showing relative strength versus the market as well. So this is the thing we should be looking for the stocks that look the strongest here. So I think this sort of can punch out of here. I mean, it's not huge volume on that little rally there, apart from the low. But yeah, it is showing relative strength there. So I think if it can kind of punch through the top of that that sort of trend line there, the overhead trend line there, I think that was quite bullish there. That's that's a what I refer to as a corrective decline. So it's overlapping in nature. So it's not like it's like a trend building on top of each other. That's obviously a bullish trend. A trend that's sort of going sideways. It's not a strong trend. So that is not a strong downtrend. Yeah.
So there's a strong downtrend here into.
Yeah, that's right. Yeah.
But this is the opposite. It's overlapping itself. The highs.
Yeah. So we saw, even with the low there, we saw how the pullback sat on top of the previous green line there and then went again. That's a nice, healthy, trend. But when they're overlapping there, it's just not a very strong. So it's not a very strong downtrend there. So it's more of a sideways decline there. Normally they sort of, if what preceded the sideways decline was a reasonably impulsive rally up into that high, and then gone sideways. That leaves it in pretty good shape. So that favors an upside break here. So I think that looks quite good. Then I say from an inflation point of view, I think we probably spoke about the why in the past there. If it doesn't sort of move, it's not like a lot of products that sort of lose value. It actually probably increases in value. So even though you mightn't get the sales numbers there, you don't lose the value there. And I think that is sort of something that even if costs do go up for Treasury, they can be easily passed along to the consumer. So if we are sort of going to a recession, which I don't think we are personally, but if we are, then we're probably not going to stop drinking. Quite probably the opposite. But yeah.
Well, it kind of bodes well on both ways, because as you're saying, they're not rushed to sell their produce. It's not vegetable farmers or milk products where they need to keep it going. Storage is relatively cheap compared to other agricultural goods, or is that fair to say?
Oh yeah, 100%. Yeah, that's exactly right. So,
well, you're going to another one that's got one-way traffic. So JHG, would you say that's a fair downtrend?
Yeah, fair downtrend. So Janus Henderson, it's funny. This one's actually pretty good trading stock here. Actually, it's obviously sort of global asset manager there, but it's just a high beta play. So if you thought the market was sort of going to go down 10%, this thing's probably going to drop by twice as much. And if the market's going to rally 10%, this thing's probably going to bounce twice as much. So it's a bit of a beta play on global indices. So Janus Henderson's obviously got a strong European presence, but it's had a pretty big decline there. So it's really pretty much halved in price here, which is pretty decent sized move here for this sort of asset manager here. So I just think if we think we're going to get a bit of a bounce here, this should, I think it'll pop up here. So I just noticed if we drilled into I've got the weeklies there, but if we drill into our dailies there, we're right on that sort of trend line. And actually yesterday we actually broke up above that trend line. So broke above that sort of downward trend line. So I do think that is an important sign. Just sort of notice it's just sort of congesting there as well. So again, that's a strong downtrend, and then it sort of rallied for 2 weeks, and then 2 weeks it didn't go to a new low. So that's actually a sign of strength for mine, because obviously this is a pretty nasty trend, and then breaking above that trend line is also a positive, and I think there's some volume occurring down the lows as well, which is interesting as well. So just good volume on the little rally, and then a little bit lighter on the pullback. So so sort of three little ingredients there, which kind of told me this could be one to keep an eye on here, and big technical level that sort of bounced off as well. So yeah, I just think it looks pretty interesting here. So if you wanted to be sort of long beta, sort of global equities there, this is an interesting one, sort of which has had a decent sort of move in the past there. Just the only downside is this one's, if you're right, you're going to get a nice move. If you're wrong, it's going to move hard against you as well. So that's the downside, is it's So they're going to win more or lose more for you if you're, depending on how right or wrong you are.
So it's one that can give a positive upside or a negative downside quite
Yeah.
quickly.
Yeah.
Looking at the other aspects of the global economy, or specifically the Australian economy, really, from the building construction side, you've picked up Reece once again in your chart here. Now, this is sort of drilled down. You've got a red box here, which looks like a bit of lows and some higher volumes. What's happened to the right of that low box? What's appealing in this sideways churn?
Yeah, so I think the thing with the construction sector is it's not too indifferent to retail spend as well. So you think here, the last 3 weeks, every analyst has been telling you not to buy retail stocks because obviously interest rates going up, less money for the consumer. Basically stay away. You shouldn't be buying that sector. But the reality is that sector has had a massive decline. So all those retail stocks have had big moves down. And so you're already pricing in the doom and gloom. So like a lot of these retail stocks are on PEs of sort of 6 and 7s and 8s and yields of 7, 8, 9s and 10%. So they're already pricing in a recession in the retail stock. So the construction is not so different. This is probably less appealing as a sector for me. I'm probably more interested in the retail legs. I think I haven't seen any weakness in retail spend so far, but obviously the construction sector has probably got a few more hiccups in there, a few more cost issues, and you've already seen a few companies go broke here. But just got to be careful not to get too bearish here. Obviously, it's almost too obvious. When everyone's saying do not go into a sector there, that's often when they sort of bottom here. So just interesting here that Reece Plumbing is sort of showing a little bit of resilience. That low was like bounced off a bit of a key support there on a weekly. I think we sort of showed that a couple of weeks back and had a little bit of a bounce, just sort of gone sideways here. So the selling starting to sort of appease here. And yeah, so it just might be, this has had a massive decline again. Again, another 50%. So again, you're basically pricing in a 50% decline. So almost a 50% decline in business, and which I think sometimes the market, by the time everyone realizes we're in a recession, it's already happened. And so everyone was worried about the retail spend drying up. The price already, action was already occurred here. So I know that everyone's sort of saying, do not go near construction there. That's like, everyone's waving the white flag here. That it might be the moment to wait in. I know it doesn't feel right. I do think this is probably one of the riskier sort of moves, but potentially we may have already priced in all the doom and gloom here right now. So I know there'll be some, potentially, I think within the construction area, there will be some more pain felt, but some of the smarter companies, some of the better companies will probably come out of this quite stronger, because obviously there'll be less competition as well. So yeah, it's not all sort of doom and gloom sometimes, just got to be careful about falling into the trap that, so if everyone's, we talked about this a few weeks back, Chris, if everyone's basically universally bearish, that means everyone's already sold. So if every analyst is saying sell, 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 that usually means they've already sold. So there's no one, what that usually means is there's no one left to sell.
So they're not going to the market and saying sell before they've sold theirs. They're only reporting to the market after they've sold.
Yeah. So just think about that. If everyone's sort of, so they're not going to sort of say, hey, it's a sell, and then the next day go and sell. If it's a sell, they've probably already sold. I think it's a sell. I've already got out of all my retail stocks. I think it's a sell. They've already positioned for that. So that's always concern there. If the market's like 98% of analysts are saying don't go near a sector, they've usually exited that sector. So that usually means that who's left to exit it, maybe 1 or 2%, and that's usually, oftentimes those are sort of turning points. So I'll just be cautious about we already saw it with, we talked about the coal sector years ago. Everyone said don't go near coal. ESG, it's no one no sort of ethical fund will ever invest in it again. Why would you own it? And what's happened the last couple of years? It's gone nuts here. So everyone said 3 or 4 weeks ago, retail spend, don't go near retail stocks. Retailers are doomed. what's happened? All those retail stocks have all bounced here over the last 2 or 3 weeks. I saw Harvey Norman's up again today over $4 or something here, I think. So it's going all right. So it's just got to be careful to sort of or people pricing in too much doom and gloom here. So just think maybe construction is not as gloomy there. Just the technicals are sort of telling me that the selling started to subside here, and so REH there is sort of started to go sideways here, sort of started to maybe build something there. Hasn't sort of broken a swing high yet, but if it does break out of that sideways move on the upside, that's likely the start of a recovery. So I'd just be watching that sort of carefully. And we've already seen with Fletcher as well, it's had a massive decline, I think 45%, which is a pretty big move here. That's sort of, Fletcher's is like the kind of Wesfarmers of Australia here. Had a big decline, and again, we're just starting to sort of break up side of that sort of descending trend line, sort of bounced off a bit of a key technical level as well, which I think is kind of interesting. And we're seeing some reasonable volume, and then the pullbacks are sort of getting tighter and tighter here. So starting to show signs of strength here, not signs of weakness there when everyone's telling us to get out of here. So look, definitely one of the riskier sectors, but potentially everyone who sold it might already have sold it as well. So that's the only thing.
There's possible upside in those building ones. Megaport's another one that's it's taken a bath since the highs in November last year. Are you seeing a similar sort of opportunity there? It's underloved. There's so many bearish reports on it, and it's started to turn the corner.
Yeah, it's just nice a few, and we sort of featured 360 in Dub and Domino's. They've had 70, 80, 89% corrections in price. So pretty heavy sort of selling here. So Megaport has gone from 22 down to 5. So that's more than 3/4 price move here. So pretty heavy sort of sell down there. Just started to, bounced off sort of an old sort of, old support level for the stock, pretty much kind of, I guess you might call that like kind of the breakout zone at the time. It basically was sort of going sideways there, and then broke out. Broke out on good volumes. That would have been that's the zone where it sort of took off here. So it's interesting. It sort of came back to that that key sort of price zone there. We're just seeing the volume pick up substantially here. So look at that volume, sort of quite large in here. So there's definitely sort of signs of accumulation taking place down here. Sort of one that could sort of build here. And just showing a bit of strength there as well. Some of these sort of, should be, we should be a little bit concerned about growth stocks here, but some of them are sort of showing a little bit of strength here. So, potentially not all doom and gloom.
That's probably brings us over to another area of the market, the healthcare space. You looked at last week and said that there are a lot of leaders in this space, a lot of the best companies you've seen in the last couple of weeks. Breakouts have been in this healthcare space, biotech, FPH, Fisher & Paykel Healthcare. Is that sort of a much larger market cap than many biotechs? How does that fit into the healthcare and the current charts?
Yeah, so obviously they did pretty well in COVID there. They sort of sell the respirator machines and stuff there. So obviously coming off the boil there, to be expected there. But it's still a pretty good growth company here, Fisher & Paykel Healthcare. So always been viewed as a pretty quality sort of group. But again, had a massive decline there, basically half in value. Just noticed sort of long-term trend line there. I sort of had that red trend line sort of drew, and then I went back and looked at some of the more recent sort of highs there on the 5-year picture. And I see that sort of the green trend line there was sort of closer to where we've sort of come back to. So it has sort of bounced off a bit of a key long-term support line, and it's some okay volume as well down there as well. So so if we sort of see it dry up here, it might be interesting. But no, you're right, Chris. We're sort of, I think, on the Friday's report we do with you, your top 30 list that you produce, I think almost close to a third of that list was medical, and also was healthcare and biomedical stocks. So they're already showing they're showing the that's the sector at the moment which is showing the most promise and showing this, I guess, the greatest strength here off the last, for the last month or so here. So, yeah, so just definitely a sector to sort of keep an eye on there. I think historically there, healthcare does pretty well in inflationary periods. So, yeah, just get I think that's it's a pretty interesting sector here. So probably just want to see a bit of a sideways sort of shimmy, maybe tighten up again. Don't go too far down and start to break up a good volume. That's could be just one to keep an eye on there.
Well, that's a good one, FPH. And the last one in the list is TPW, Temple and Webster. You've mentioned this a couple of times before. You've traded it quite successfully a few times before. And you've got on this week's report, high risk stock bounces from key support. So
yeah, so it's in that high risk area there, sort of high growth there. But I mean, it's I think we sort of talked about the the 80-50 rule, how 50% or what 80% of those stocks or the leading stocks will will pull back 50%, and then 50% of them will come back 80%. So in this case here, we've sort of come back 15 down to $3 there, sub $3. So it's already had that massive sort of correction there. What's sort of 70-80% decline here. So just coming back to a long-term trend line as well, and just start to see volume pick up a little bit here over the last sort of month. But what we've seen here is the price has actually stabilized the last 4 weeks. So really sort of almost gone sideways for 1, 2, 3, 4, 5 weeks here now. So this means it's the selling starting to subside. And I mean, this is obviously aggressive downtrend. So the fact that it's sort of starting to congest here is just showing it. So look, it might need more time to stabilize here, but it's just interesting. Some of these sort of high growth, some of these most beaten up stocks are showing a little bit of strength there, starting to stabilize there. Some of the sectors that we're being warned to sort of stay away from are actually showing a little bit of strength. So just, I'm not sure this market is, I say like everyone's pretty bearish here, but the technical picture actually isn't sort of showing that. It's actually showing some really signs of strength here. So just be careful not to get too bearish either, I guess. So yeah.
There's some good companies to look at, and no doubt you'll update next week as the top trading shares. It's also probably good. You've mentioned a fair few thematics in this week's report, and when you talk through the charts, and that's probably the importance of getting the tailwinds right. And you did discuss that in quite a bit of detail in last Friday's report. So you can click on screen to see that playlist of reports. And then also springs, sometimes false breaks, some reversal patterns. There's also more detail on that on screen. So Gary, that's another insightful weekly report from you. And we do thank you for sharing that with us. If anyone wants to get in contact with you, that's also on screen as well, isn't it?
Yeah, no, thanks, Chris.
Well, thanks again, Gary Glover from Novus Capital.